So Peter Rossi is a guy who's rejoined us recently after 12 years working for Woolworths. We're thrilled to have him back in the company, and he's here this morning to give us a rundown on what's happening out there in the marketplace. Thanks, Peter. Welcome. All right, Peter, let's start with a bit of a rundown on where you see the retail investment market. What's the activity like out there in the marketplace at the moment?
We're seeing in the market at the moment that a lot of investors and owners are viewing their retail assets as reasonably liquid assets, given the strong purchaser demand. Really, at the end of the day, we could probably sell half a dozen regional centres if we could get the listings today. So there's a good strong demand there. We're seeing yields are tightening a little bit in the quality stock, and we're seeing that sort of start to trend downwards, as we can sort of see on the slide there. I think we're sitting around the 8% at the moment. I expect to see that tighten down to sort of 7.5% for those centres that are in the growth areas and demonstrating demand.
That's interesting because I mean, as you put on the chart there, you make the assumption that the yield will start to tighten virtually straight away.
Yeah, look, I think there's, in the market over the last few years, there's been a lot of bottom fishermen, and I think the bottom fishermen may very well have missed the boat.
Okay. What about the development, hot or cold spots? I mean, there's been a lot happening in southeast Queensland over the last 2 or 3 years. Are you seeing any sort of variation in centre quality? Have some gone too early into locations that can't be supported, and how has that been reflected in the investment market?
It's an interesting question because development obviously follows growth in the retail sector, and the supermarket chains specifically, who are the anchor tenants, are chasing long-term sort of 40, 50 years positions. So for them to enter into a market 5 years prematurely does make a lot of sense when you look at the 50-year picture. And I'm quite sure that some of the developers out here are seeing centres that are coming onto the market or that are coming into fruition that are in quite futuristic places. But development follows growth. 50,000 people a year coming into southeast Queensland, that's 5 or 6 new supermarket-based centres. Development is in fact lagging, and I think that's as much to do with the planning regime as it is to do with developers and potentially with funding. Land costs have gone up. There's been a profit shift back to the landholder away from the developer, I think. So that's really interesting. I think what we'll see in the market shortly, there'll be some centre expansions, and obviously the ACCC decision is going to be a motivator for that. So I think that's one of the key features that we're seeing.
Mm-hmm. Okay. What about the retail leasing side? It's the one thing we always look at in a softer period, whether or not there's actually still demand from retailers to fill new centres. How are you reading the retail leasing market at the moment?
The leasing market, I suppose, broadly broken down into 3 categories: CBD, outside CBD, and then the bulky goods market. Within the CBD, I saw you were reporting some increase in vacancy there, and I think that's generally a function of a lot of the CBD sites positioning themselves for redevelopment in the next development phase, and that tenants are getting displaced there. Queen Street is still very, very strong. And we're seeing sort of 5,000, 6,000 a metre readily achievable there. What's interesting is the acceptance by the luxury brands and the international brands of Brisbane as a destination of choice. And so what we're seeing is those people are starting to gravitate probably towards the Edward Street sector there, and we're seeing sort of very strong take up there, and rents sort of $3,500 a metre and in that sort of range. So that's very good. Outside the CBD, in the neighbourhood centres and in the sub-regionals, what we see there is that the nationals are very, very strong. We're seeing all of the national brands filling into those centres, but generally mums and dads are finding it difficult to get start-up capital for their businesses, so they're struggling at that end at the mum and dad traders. Bulky goods, again, it's the same old retail story. Development follows growth. New developments have been a bit patchy. We've seen rents take a little bit of a hit, and incentives have slid upwards a bit. So that's an interesting sector that I think has probably got a good future on the basis that we can get some of this residential land released.
Mm-hmm. The retail sector is always known for doing something different. There's always the new thing coming up in retail, be it a centre design or some other feature of the retail market, legislation, say. What are the other observations you see in the retail sector for the year ahead?
Oh, Kevin, I briefly touched on the ACCC undertakings that they've achieved from Woolworths and Coles, that they're not going to enforce their restrictive covenants in their leases. So what that effectively does, that if you've got a shopping centre that's capable of accommodating a second supermarket or an expansion that may include a smaller trader, an IGA or an Aldi or Foodworks, for example, you'll actually see those centres start to expand. So if there are centres out there that have got expansion potential, that's now liberated a bit of that expansion potential. So I think that's a really good thing for the industry. Obviously gives some of the centres an ability to take the leap of faith from being a neighbourhood centre into a sub-regional, and there's a couple in the wings like that. I think we're seeing Wilson's a recent transaction done by a local developer that Mark Greer transacted. So that's that's a good move. South East Queensland's got great population growth. Retail follows population growth, so I think we'll see the yields tighten. And in very, very many regards, I think we're the sweetheart of the retail investment sector. So I suppose my advice there is that if you're fair income about marketing your centre, get it in the paper. There's a lot of centres supposedly on the market, and I suppose as a re-entrant into the agency business, there's a lot of stuff that's touted as being for sale. A number of investors have been doing due diligence on these centres, and it costs $30,000, $40,000, $50,000, $60,000 to due diligence on a centre. If it then gets pulled off the market, I think there's a number of investors out here who will find that they quickly get the shits with that. So, if you've got a centre to sell, I think get it on the market. Get it advertised in the paper, and I think you could benefit from what we're seeing as being a compression of the yields in the next 6 to 12 months for the right centres.
Yep. Okay, that's a very strong sort of message, I think. Get the properties out there, get them on the market. We sort of hear that in the other sectors too, that at a time when properties are being withdrawn from the market, it's important to send a clear signal that you are actually there and ready to sell.
Certainly, there's nothing like sticking an ad in the paper.
Okay. Right, Peter, thanks very much for those insights this morning. Terrific stuff. Thanks.
Okay, thanks.